So welcome to DAC6 for corporates. Thank you for joining us today to our webinar and taking your time off your busy schedule. The webinar will be led by myself, Anna Szkudlarek, and Paul Millen. We're both partners at Bluebridge. If you have attended our webinars before, it's one of our series of webinars that we deliver on DAC6. Bluebridge is your partner for DAC6 services, and our aim is to deliver peace of mind and freedom from DAC6 to our clients. We provide 3 services: report production, reportability analysis, and liability relief. So we can help you with the XML conversion of the report so that you can submit it on your local portal. We can also assist you in the assessment analysis of the reportable information. And if you involve us early in the process, we could also take over the responsibility for the reporting as an intermediary. So these are the 3 services we provide. But today we're talking about the Intragroup Hallmarks for corporates. And with that, I'll go through the housekeeping points first, and then hand over to Paul, who will walk you through the webinar. So the webinar will take 1 hour today, and in the end, we plan some time for you to ask questions. If you want to ask questions during the webinar, please ask them using the chat box. I ask you to remain muted with your webcam off if possible, because this helps to reduce background distractions when presenting over Zoom. We're recording this webinar, and a copy of the recording together with the slides will be made available to you via email, but also with a link to our blog. So as I said, the focus of the webinar today is a corporate world. So we're talking about the groups and the hallmarks that are relevant to their activities, which may give rise to reporting obligation under DAC6. So with that, I hand over to Paul.
Okay, thank you, Anna, and thank you everyone for joining us today for our webinar on the Intragroup DAC6 Hallmarks. And I need control of the slides.
Okay.
No.
No, should we? You're going.
Okay, thank you, Anna. So today's presentation, the objective of this afternoon's presentation is to explore these DAC6 hallmarks, which target the cross-border transactions between the related parties. And what makes these transactions different from normal market transactions is that the outcome, the value of the outcome, is usually going to be determined on a consolidated, aggregated basis. So you have 2 parties, one of which might be regarded as a winner in the transaction and the other as a loser. But what matters is that when combined, there is an enhanced profit for the overall group. So it's for the group, it's profit on an aggregated net basis. Now, there's 2 general categories of hallmarks under DAC6 that focus on these types of transactions. The first set are the Hallmark C transactions, and these seek to arbitrage differing treatments in different jurisdictions for key tax components. This can be as straightforward as different tax rates. You might have a 25% corporate tax rate in one country and a 0% in another. You might be trying to take advantage of that discrepancy, or it might be more complex. It might have to do with timetables for depreciation or the use of hybrids or asset valuation techniques. The second category of hallmarks of particular relevance to these types of transactions are the transfer pricing ones under Hallmark C. And these transactions tend to exploit uncertainty or challenges to the standard transfer pricing model and regulations. And the key ones here are known as either the transfer of hard to value intangibles, which we'll define later, and the use of unilateral safe harbors. And in general, this webinar will explore the varying EU-wide interpretations and applications of these intragroup hallmarks in the context of a non-financial group, along with the mechanics of the DAC6 disclosures for an in-house legal department that needs to do the reporting on behalf of the group. This is different from the normal DAC6 situation where the intermediary doing the reporting will tend to be an external party. Okay, before we get into these particular intergroup hallmarks, let's have a quick refresher on what DAC6 is and how it functions. So what do we mean when we say DAC6? Well, DAC6 is the amendment to Directive 2011/16/EU on administrative cooperation in the field of taxation. It's essentially a Frankenstein monster of different tax regulations. It has the OECD mandatory disclosure rules targeting CRS avoidance, coupled with transfer pricing standards, EU transfer pricing standards, mixed together with other activities regarded as quote unquote aggressive tax planning. DAC6 mandates the disclosure of cross-border arrangements which concern one or more EU member states and implicate one of the tax attributes deemed indicative of aggressive planning. And these tax attributes are referred to as hallmarks. So if you have a cross-border arrangement, you test it against the hallmark, and if it meets that hallmark, it's a reportable cross-border arrangement. Some of these hallmarks also have what's called the main benefit test, the test of tax benefits, and it functions as a second level criterion. So that particular cross-border arrangement has to meet both the hallmark and the main benefit test in order to qualify as a reportable cross-border arrangement. The timeline of DAC6 has been under serious strain due mainly to the pandemic, of course, but due to other factors, normal preparatory growing pains for quite a new regime. So it was originally scheduled to launch in the 1st of July last year. Then it was deferred to the 1st of January of this year in most jurisdictions in the EU. And since then, we've seen sort of an eclectic mix of various jurisdictions impose delays or non-enforcement provisions for missed deadlines. And so you can say that the timeline is started mainly on the 1st of January in principle, but it will depend on the exact jurisdiction for the exact date of when DAC6 began and when the first reports were due or will be due in certain situations. So how does it function? Well, again, if you have a cross-border arrangement that meets one or more of the DAC6 hallmarks and the main benefit test where applicable, it qualifies as a reportable cross-border arrangement. And for every reportable cross-border arrangement, or RCBA, EU-connected parties that qualify as intermediaries with respect to the arrangement, or if there are no EU resident intermediaries involved in the arrangement, then the EU taxpayers who benefit from the arrangement must report it. And for each RCBA, the reporting party must disclose the following information. Information about the transaction itself, so the details of the transaction itself, and the parties involved in it. And this is a broad category because it not only includes yourself as the intermediary doing the reporting, of course, any other intermediaries who you know were involved in the transaction, any relevant taxpayers or beneficiaries of the arrangement, people, your clients, if you will, or the people who benefit from it, as well as related parties, related enterprises, and any other person, EU resident person who's involved in or benefiting from the transaction. So the reporting casts a very broad scope for certain transactions in terms of what the quantity of information that needs to be reported. These reports must be submitted to the local competent authority, usually across the conventional tax reporting portal, and within 30 days. So a very tight timeline, within 30 days from the trigger event, they call it, which is usually the first step in the implementation of the reportable cross-border arrangement. And then this information will be exchanged on an automated basis with other EU member states. And I think it's on a quarterly basis. So every 90 days or 3 months, the EU member states will exchange the information amongst themselves. Now, I talked about the intermediaries. So what do we mean about intermediaries, and why is DAC6 focused atypically for a tax regime on the advisors rather than the taxpayers? Well, the declared aim of DAC6 is the gathering of information sorry, I've lost control. There we go, sorry. The declared aim of DAC6 is the gathering of information on emerging aggressive tax schemes with an EU nexus, rather than seeking to enforce EU tax laws throughout all of the EU member states. To wit, DAC6 is more interested in the transaction than the people who benefit from the transaction, even if those people benefiting from the transaction are potentially on the wrong side of the tax law. With that in mind, DAC6 seeks to identify the so-called intermediaries. And these are the persons involved in the transaction who are best situated to disclose information about the arrangement itself. These would be the tax advisors, of course, the lawyers, the accountants. But as you'll see in a moment, the scope of the definition of intermediaries is much wider than that. DAC6 sets forth 2 types of intermediaries. You have promoters, and promoters are any person that designs, markets, organizes, or makes available for implementation or manages the implementation of a reportable cross-border arrangement. This makes a lot of sense. These are the people who have devised the reportable cross-border arrangement. They've determined how it needs to interoperate with the local tax laws in order to provide the tax benefits that it promises. And they have gone out typically and they have sold these programs, these arrangements to interested parties. So certainly these are the people who would have be the best sources of information if you're interested in aggressive types of tax schemes. The second type of intermediary is a bit less intuitive. It's called service providers. And a service provider type intermediary is any person who provides aid, assistance, or advice in connection with the design, marketing, implementation, or organization of a reportable cross-border arrangement. If you stop to think about it for a moment, that is an incredibly broad scope of persons who could be tagged as intermediaries under DAC6. I mean, for example, someone at your local copy store who makes copies of a deal papers involved in a restructuring are providing assistance in connection with the implementation, potentially, of an RCBA. With that in mind, DAC6 applies a few limitations. The key one here is what we refer to as the ignorance defense. And this states that if the service provider, not the promoters, only service providers, does not know or could not be reasonably expected to know that the transaction could qualify as a DAC6 reportable arrangement based on all the information available to that person, then they will not qualify as an intermediary. So if you're just doing your job with your head down and going on around you as an aggressive tax scheme that you have no real awareness of, then you're not stuck with any disclosure responsibilities under DAC6. So that's the biggest, most common exception and the one that I think we should all be most grateful for. The second exception is a slightly different one. It functions differently. It's called legal professional privilege. And under legal professional privilege, you do in fact qualify as the intermediary, but then you're exempted from the reporting duties. And this would apply where you have, as it says, a legal professional privilege. So under your local law, attorney-client privilege or something very similar would attach to the information that you would otherwise need to disclose under DAC6. And under this theory, the attorney-client privilege under domestic law takes precedence over the DAC6 disclosure requirements, and therefore you are not obliged to violate confidentiality and disclose the information. You're not totally free from DAC6 compliance duties, but you're not obliged to do the reporting on information that would violate attorney-client privilege. So this is the general scope of intermediaries under DAC6. Now let's look at how this is affected in the corporate group world. Come on. Okay. In general, it's the same definition. They don't have special definitions for corporate groups or intergroup hallmarks. So if you're a non-financial corporation, manufacturer, consumer goods company, technology company, shipping company, et cetera, it's the same as it is in the financial sphere. It's the experts who prepare and deliver tax advisory services to their clients and help them implement them. The key difference here is in the practical impact of these rules. As I mentioned a moment ago, you typically have your intermediary, is an external party, a law firm, a tax advisor, a Big Four, an accounting firm, someone like that. So you have a distinction, clear-cut, pragmatic distinction between the client and the service provider. However, in the corporate group context, that line can often be blurred. And in this context, the parties may be the same person. You may be your company may be both the intermediary providing the tax advice and the relevant taxpayer who is benefiting from this tax advice. So the definition does not separate between the two or distinguish. It captures in-house experts from either specialized departments or even separate subsidiaries where those experts are designing and advising on reportable cross-border arrangements, which will be implemented by the other group members. And there are no special treatments other than in some of the reporting duties that will apply to intermediaries or relevant taxpayers who are implicated by DAC6 reporting duties. So that's the general scope of DAC6, how it captures corporations as intermediaries or corporate groups as intermediaries and relevant taxpayers, and how it functions. Now we're going to look at some of the specific hallmarks that are most germane to the corporate, non-financial corporate group context. Okay. So this is a table of all of the hallmarks applicable in DAC6. And as I mentioned at the onset, DAC6 is a bit of a Frankenstein monster. So you can see hallmark D, it's all about CRS and beneficial ownership. Hallmark E is all about transfer pricing. And hallmarks A, B, and C are much more about what they deem to be aggressive tax planning practices that are common, or at least feared to be common in the EU. Now, what we're going to do today is we're going to focus on two different types of hallmarks. The ones that you see in the red boxes, these are the main focus of today's webinar. These are the hallmarks that are going to most commonly implicate corporate groups due to their fairly common commercial activities or their tax-driven activities in certain circumstances. And then we'll also touch upon towards the end under hallmark B, these are some of the popular tax sheltering methods. They apply inside corporate groups, outside corporate groups worldwide, but since they are relevant to corporate groups, we are going to discuss them. As for hallmarks A and D, they could, of course, apply in a corporate group context, but they're less relevant than in the corporate group context than, say, in the fiduciary or private wealth management or financial sphere. And so we're not going to go into details on those today. So before we move forward into the specific hallmarks, if you look at the bottom left of your screen, you'll see the definition of the main benefit test. As I mentioned earlier, for these hallmarks on the left side of your screen, A, B, and half of the C hallmarks, in addition to meeting the hallmark itself, a cross-border arrangement must also satisfy the main benefit test in order to qualify as a reportable cross-border arrangement. So what does the main benefit test do? Well, it mainly adds a tax-driven aspect to certain hallmarks that otherwise could be too broad and generate too over-reporting on matters that are really not related to tax avoidance, tax planning, or anything that DAC6 is purportedly interested in. So the MBT queries whether the main benefit or one of the main benefits of the cross-border arrangement is the obtaining of a tax advantage. So a reasonable approach and makes sense. If you're trying to add a tax flavor to an otherwise non-tax topic, that's a pretty good way to frame it, I think. The issue with the MBT, the main benefit test, as written in the DAC6 directive, is that it's toothless. It doesn't have much bite to it. It's more pretty much any type of arrangement, if it satisfies a hallmark, is overwhelmingly likely to satisfy the main benefit test as well. I'm not going to go into detail on that today. We had a whole webinar on the main benefit test already, and you can find it online if you'd like to see it, or you can get in contact with us if you have any questions about it. But just to say that in response to the lack of force in the main benefit test as written in the DAC6 directive, many EU member states have enhanced the main benefit test as part of their local guidance. And we covered that in the webinar as well. But just so you know, the main benefit test is now not a single test EU-wide, but a handful of different tests that may be different in Cyprus than it is in Germany than it is in Spain. So like with many of the issues that we're going to be looking at today, it is no longer adequate to look at what the DAC6 directive tells you something is. You must refer to the local guidance in order to ensure that you fully understand what the scope of any of these topics are in your specific jurisdiction, or in whichever jurisdiction is relevant to your particular cross-border arrangement. So let's go into the hallmarks themselves, and this will be the meat of today's webinar. So I've moved quite quickly up until now, and I'm going to slow down a bit for this topic. Okay. So the first set of hallmarks we're going to look at are the hallmarks C1. So hallmarks C has C1, A through D, including B little I and B2 little I, and then it has hallmarks C2, C3, and C4. So we've split them in between C1 and C2 to C4. We're going to start with C1, and these we refer to as the deductible cross-border payments. So the hallmarks C1 target deductible payments amongst associated enterprises where the payor tends to be in a high tax jurisdiction and the recipient in a low tax one. Before we get to the specific C1 hallmarks, let's break apart that sentence a little bit and make sure we all understand what all these terms mean and what they don't mean. So the first thing we want to talk about, first concept we should discuss, is deductible payments. Deductible payments are essentially business expenses. The main ones you'll find will be salaries and rent for most businesses, but they also refer to payments, interest payments on loans, entertainment, a variety of other activities. That's what a deductible payment is for DAC6. Now there's another type of expenses in the real world, and these are your capital expenses. This is when you buy a building, or you buy machinery, or you buy an IT system, or anything along those lines. These are called capital assets, and rather than take a tax expense in the year that you purchase the asset, you have to depreciate, or if it's an intangible, amortize the asset over the lifespan of the asset, which could be anywhere between 20 to 30 years for real estate, or it could be 5 years for machinery. It really depends. Usually jurisdictions have set schedules of depreciation depending upon what type of capital asset it is. But the key point here is that capital assets are not treated as deductible payments under Hallmark C1. It's the more conventional expenses, the ones that you can expense in your taxes that current year, salaries, rent, interest payments, things along those lines. Okay, so you're making a deductible payment here and not buying a capital asset. Now, amongst associated enterprises. So associated enterprises is the DAC6 terminology for related parties. So these are entities that have ownership stakes. One has an ownership stake in the other, or vice versa, or they have a common parent. So there's a holding company that holds both of these entities, or they have a common investor who holds large stakes in both entities, and they're not technically aligned, but the individual, he or she, holds sufficiently large stakes that there could be an interest in setting up transactions between these two entities that maybe don't benefit both of the entities, but will benefit the owner of both of the entities on a consolidated basis. There's also, in addition to direct ownership, there's control by other means that can treat you as an associated enterprise. What they're really looking for is someone who's able to dictate to both of these parties, you have to do this arrangement. It's in my interest, irrespective of whether it's in each of your interests. Related parties again. And the final concept to look at before we jump into the individual hallmarks is, what do we mean by recipient? Well, it seems pretty obvious, right? The person who gets the money. Yeah, we're used to that term in plain English. The key point here is in the situation where the entity is we're looking for the tax recipient, not necessarily the payee. So in a situation where the payee is a tax transparent entity, a partnership, for example, you're not looking for where the partnership is located, you're looking for where the partners are located. You are tracking where the taxpayers are resident, not where the transparent entity is resident. Okay, with that in mind, let's go into the specific C1 hallmarks. Now, the first one is hallmark C1A, where the recipient has no tax residence. Okay, this is an interesting one. So tax residence from an entity standpoint is based usually on two different pillars. You have place of establishment or incorporation. Your company was set up there, you're registered there, you are resident there for tax purposes. The other main standard you see is the place of effective management and control. You do the administration of the entity out of the jurisdiction, and therefore it is tax resident in that jurisdiction. Other places, they combine the two. They have either or both establishment or place of effective management and control. Now, what do they mean by no tax residence? Well, certain jurisdictions have no corporate tax, and therefore they don't bother to create a standard of corporate tax residence. That is not what they mean in this scenario. That's what you'll see for the next hallmark we'll look at. If you would meet the normal standards, you're incorporated in a jurisdiction then that's not going to qualify as no tax residence. What they're looking for in hallmark C1A is statelessness. Usually this means you've set up the company in a way to deliberately take advantage of a gap between two countries' different definitions of tax residence. So let's say you incorporate in a jurisdiction that has strictly place of effective management and control as the standard, and you manage it out of a jurisdiction that has strictly place of establishment as its definition of tax residence, then you have a stateless company. And a stateless company well, it's seen to be as an aggressive tax maneuver. It usually needs to be set up deliberately that way. And of course, it can happen accidentally. But that is what the DAC6 is seeking to identify here. Now, C1b(i), this is the much more standardized situation where you set up a company in a jurisdiction that has no corporate tax. Obviously, tax haven is a word that is often applied to these jurisdictions. And usually they have zero, they just don't have a corporate tax. But some of them, because they see a 0% corporate tax, can be quite quite a stain on a jurisdiction's reputation, they have a very low tax rate. And the question is, what counts as a near zero tax rate in order to meet this particular hallmark? Once again, we face fragmentation across the EU member states for this definition. Some say 1%, some say 2%, some say as high as 4%. Obviously, these are all very low tax rates, but it is of course possible that that the arrangement will meet the hallmark as set forth in one EU member state, but not as set forth in another EU member state, which will cause an array of complications for any corporation, group companies that are trying to consolidate their DAC6 reporting upon a single entity. And of course, for anyone else who's having to do DAC6 analyses and always having to look in every single source material for any place that might capture a particular arrangement. The next hallmark under C1 is the recipient on an EU OECD, is it in an EU OECD blacklisted jurisdiction? So these are mainly based on the OECD's global forum. That's what they mean by the OECD here, and the EU is sort of skating on, working off of that list. And the OECD has basically identified a bunch of jurisdictions where they think the anti-money laundering rules are either weak or poorly implemented, and they do examinations or audits. And they started them, I don't know, 10, 15 years ago, I think, at least under this name, under the Global Forum name. And they blacklisted a bunch of these jurisdictions as not compliant or not sufficient. Many of them have tried to recover by fixing their AML rules and upping their game, and then having the OECD Global Forum come back in and give them a better evaluation. So this list no longer covers places like a BVI or a Cayman or something like that. Many of those have reformed their ways, at least to get off this list. The tricky thing here is there's two little wrinkles here. Each EU member state seems to have a choice of which blacklist they apply. So some say the EU list, some say the OECD list, and some say both, or some say we have our own list in our jurisdiction, we want you to use that one. So once again, you're compelled to see DAC6 is not a single unified regime, but really a fragmented regime across various EU member states. The other wrinkle is timing. Most of the local guidance seems to agree that the determination of whether the recipient is or is not resident in a blacklisted jurisdiction should be made on the date of the trigger event. So the execution, the first step in the implementation of the cross-border arrangement. That seems to make sense to me. But just so you know, it's not at the beginning of the year. It's not as of the date DAC6 was promulgated. It's not when the reporting is due. It's on the date of the first step is when you need to check these lists and see who's on there. Currently, the list, at least the EU, it doesn't, at least to my view, and perhaps it's a bit naive, doesn't cover a lot of jurisdictions that you would think European companies do a ton of business with. There is one, however, that will play a big role, and that's Panama. And not that everyone trades with Panama, but Panama is a well-established flag of convenience jurisdiction. So many shipping companies will have some relationship with Panama. And when they make payments to them, as long as Panama stays on this list, then that's going to mandate a report here. I just got a question. Thank you. I think the question was, let me check it again, but it's what if the transaction took place prior to the addition of the country onto the list? Well, if the transaction was complete and the payment was made before they were on the list, then based on what I said about when you need to look at the list, that would not qualify under this hallmark. But one thing you need to keep in mind is that this looks at payments rather than the contract date. So if you have multiple payments on a contract and on the date of the first payment, they might not be on the list. On the date of the third payment, they might be. Then you need to consider whether you need to report under that hallmark. In addition, substantial modifications or alterations to to contracts would constitute under DAC6 a new arrangement. So if you extend a credit facility, or if you can't even think of it. I mean, if you substantially modify an agreement, it's usually going to be treated as a new arrangement rather than a pre-existing arrangement. And that can bring you into DAC6, even if the original arrangement predates DAC6, or if in this case, if it predates the inclusion of a certain jurisdiction on the EU OECD blacklist. Okay, Hallmark C1C, payment is tax exempt. Not a lot to explain here, except just to clarify that the tax exemption needs to be based on the payment itself rather than the status of the recipient. So this doesn't cover situations where the recipient is a pension fund or charity or otherwise a tax exempt organization. So it's not as if all payments to charities need to be disclosed because they're tax exempt. This is just where the payment itself, due to local laws, sometimes it's real estate investment. In the US, we have the portfolio interest exemption, which would be borderline here because it's only for non-US persons, but I think it would apply, where it's the payment itself is tax exempt in that particular jurisdiction, and presumably is not tax exempt everywhere. It's usually going to be taxed, but for some reason it's exempted in this jurisdiction. Usually it's an incentive to investment, but could be a variety of other reasons. And then C1D, and this will be a pretty popular one, I think, is the payment is subject to a preferential tax regime. So this means that for certain types of activities, the income generated by that activity is subject to a reduced tax rate below the normal income tax rate for corporations. The most common ones of these are patent or license boxes, where you can store your intellectual property in a holding company in a certain jurisdiction, and you can enjoy significantly reduced taxation on the royalties you receive for that particular intellectual property. You also see it, though, with software development, where they're seeking to encourage you to set up your software development companies in their jurisdiction, and so they give you a better tax rate. Tonnage for shipping. I mean, there's a whole variety it can be, but the one most common has got to be the patent and license box. People love setting those up, and they're often criticized. And what they're criticized for is whether they are harmful. Now, there's a whole set of criteria for what determines something to be harmful or non-harmful, but it's an issue that the EU has looked at over the last couple of years, and they've done an analysis of the various EU preferential tax regimes, and they've declared that some are harmful and some are non-harmful. Now, why does that matter? It matters because different EU member states have taken differing positions on whether this harmful versus non-harmful matters. So, for example, certain jurisdictions will say if the preferential tax regime was declared to be non-harmful by the EU, then it doesn't qualify as a DAC6 preferential tax regime. Unsurprisingly, that's the jurisdictions that have preferential tax regimes. For those jurisdictions that tend not to have preferential tax regimes, they come in and they say harmful, non-harmful, doesn't matter. If it's a preferential tax regime, then you have to disclose it under DAC6. Once again, we see the fragmentation where you could have this exact same arrangement be treated as reportable in jurisdiction A, EU member state A, and non-reportable in EU member state B. So you always need to be checking all of the relevant local guidance for your cross-border arrangements in order to determine what is reportable and what is not. Okay, so that's Hallmark C1, deductible cross-border payments. Now we're going to move to the Hallmarks C2 and through C4. Anna, can you switch me over, please? Thanks. Okay, these we refer to as the cross-border mismatches. So these hallmarks target the exploitation of mismatches between tax treatments in different jurisdictions. So we put Hallmark C2 and C3 together because they're usually based on the same structures. And Hallmark C2 says you're taking depreciation on the same asset in multiple jurisdictions. And Hallmark C3 says you're getting relief from double taxation in multiple jurisdictions. Okay, what do we mean by that? Well, first off, what do we mean by depreciation? As I mentioned at the onset, certain types of expenses you can deduct from your taxes in the year that you incur that expense. Other ones you need to depreciate if it's a tangible asset, or amortize if it's an intangible asset over the lifespan of the asset. Usually that lifespan is set in the tax code. And it depends. Sometimes it's called straight line depreciation. If it's a 5-year lifespan, 20% every year. Other times you get accelerations where you can get 40% in the first year, 30 in the second, and then it gets reduced over time. Politicians love to play around with depreciation rates and timelines and everything because it can push capital investment forward and therefore give a jolt to the economy before a key election. So you can't really ascribe too much significance or meaning to these timelines or the other rates that are used. But that is the concept. And it's possible, of course, that when you own an asset that and it's used in multiple jurisdictions, that you're looking to take depreciation in both jurisdictions. Now, what's key here is if you're actually paying taxes on the income earned through that capital asset, machinery or building or whatever have you, in both jurisdictions, that's not considered to be a satisfaction of Hallmark C2. It's only where you're only paying tax in one jurisdiction for the use of the income generated by this capital asset, but you're taking depreciation in both of these jurisdictions. And the ways that this is done is usually through either permanent establishments or transparent hybrid entities. So a permanent establishment is an operation outside of your jurisdiction of tax residence that has sufficient substance that you essentially become a local taxpayer for all of the economic activities that you conduct through that permanent establishment. So key examples of this would be if you have an office and employees, or a factory, or any sort of substance, any sort of significant long-term substance within the jurisdiction. At a certain point, you cross the line from just doing business in that jurisdiction, selling something to someone there, versus actually becoming a full-fledged taxpayer in that jurisdiction. Now, the thing about permanent establishments that make them interesting is they're not subsidiaries. They're not separate entities. They are divisions, if you will, of the headquarters, of the home country, of the home company and the mother country. And so from the perspective of the home country, this is just more money that the company is making. It just happens to be overseas. They generally, outside the context of a double taxation treaty, don't really think of permanent establishments as being in a different country as being particularly relevant to them for tax purposes. They just see this as more money money coming into the country from other sources, but they don't really care if the government in the jurisdiction of the permanent residence is now regarding all that income as taxable within that jurisdiction. Now, and this means that, of course, where you're paying tax in both jurisdictions, you can try and take depreciation on the same asset. And to the extent that the tax you're paying on the permanent establishment is somehow not or somehow deductible through tax credits or something to the headquarters in the home country, that depreciation is basically being taken twice on the same asset in multiple jurisdictions. The other example similar to this is where you have a subsidiary, but what you do is instead of that subsidiary being treated like a taxpayer in that jurisdiction, you treat it as a transparent entity. And the most common way, the most popular or familiar way this takes place is through the check the box elections, where you turn something that is established in the overseas jurisdiction as a corporation, and you check a box under your home country's tax code to treat it as a transparent entity, or possibly even a disregarded entity, if you have that concept. Now, once again, in your home country, they ignore the existence of the subsidiary in the overseas jurisdiction, and they treat all of the income earned by that subsidiary as directly attributable to the headquarters in the home country. Whereas in the jurisdiction of the subsidiary, which is not transparent for local purposes, they see it as just another corporate entity with the same rights and responsibilities as every other corporate entity. And in this way, you can end up having to get you're getting double taxed on the same income. But if you have tax credit systems or similar types of activities that allows the headquarters to deduct the tax paid in the jurisdiction of the subsidiary, then you can end up with depreciation being expensed twice on the same asset. The other example we see a lot of with this is leasing arrangements. So if you buy an airplane and you lease that airplane to an airline over 30 years, depending upon the various rules in the jurisdictions, both parties might be able to take depreciation on that airplane, excuse me. Both the owner who has leased it to the airline and the airline who has leased it and now operating it. Now, there's some tricky bits here about what precisely you're depreciating if you're the airline. Is it the airplane itself or is it the lease? If you're in that situation, that's probably a good time to look for some outside expert advice. But in general, where you have a leasing arrangement and both parties are going to take depreciation on the object of the leasing arrangement, then you'd be satisfying Hallmark C2. The multiple relief from double taxation works in a similar fashion with the same structure. Usually that means there's income coming from a third jurisdiction. That income has been taxed in that jurisdiction, and both the jurisdiction of the PE or the subsidiary and the jurisdiction of the headquarters or the mother company are providing relief from double taxation based upon the tax in that third party jurisdiction. So that's Hallmarks C2 and C3. C4 is an interesting one. So here we have transfer of assets where there's a material difference in the price used for tax purposes. Now, an example could be a simple one is in one jurisdiction, they say, well, for tax purposes, it's always the cost. As long as it's an arm's length third party transaction, whatever you paid for it, that's the cost. And we'll give you depreciation or expenses or what have you based upon that, or even the income if you're the seller of the asset. Other jurisdictions might say, no, we always want to use fair market value instead of a cost basis. This can happen. A more interesting example, I think, is the case of an installment sale. So I think it's more likely to come about in these situations. So an installment sale is where you make multiple payments for one good. So let's say you buy a machine and the sale price is $60 US. And on the day you take ownership or possession of the machine, you pay 20 of those dollars. And then under the contract, you've agreed 1 year later to pay 20 more, and a year after that to pay 20 more. And the total would be 60. Now the question is, what's the price that you've paid for that machine? Most people would say, common sense, $60, 20, 20, 20, $60. Maybe if you're really clever and an economist, you want to say, oh, but net present value, it's reduced and stuff like that. Okay, that makes the most sense. But certain jurisdictions add an extra layer of complication and they say, no, you didn't pay 60 for that. What you did is you paid 20 and you took a $40 loan from the person who sold it to you. And then you paid back that loan in 2 tranches. And ultimately, the amount you paid was 60, but some portion of that 60 has to be treated as an interest payment. Let's say 5 of that is an interest payments on the loan. And therefore, the correct valuation of that asset is not 60, but 55. So in situations like that, you're going to have Hallmark C4 come into play. Now, fortunately, it's a little bit caveated by materiality. So if there's just a few dollars difference, or even in my installment sale example, that's probably not going to be, especially with today's interest rates, it's probably not going to be a material difference or a material amount. But once again, we're looking at fragmentation across EU member states, and they define materiality different. Certain EU member states say it's a 10% price difference. Others say it has to be as high as 25% in order to qualify. But once again, you'll need to check with your local regulations if you have a situation where there is a difference in the price used for tax purposes in order to determine whether it's a material difference in the price, in order to determine whether you have a reporting duty for that particular cross-border arrangement. Okay, that's Hallmarks C2 through C4. Can we jump to transfer pricing, please? Transfer pricing. So these hallmarks target the problem areas of transfer pricing for intragroup transactions where the arm's length standard is not particularly applicable. So let's break apart that opening sentence. So when they refer to intragroup transactions, they mean, and this has been confirmed by the DAC6 working group, they mean transactions between associated enterprises, or more commonly called outside of DAC6, between related parties. So when you have an intergroup transaction, you have an intergroup transaction when the two parties are associated enterprises of one another. What is the arm's length standard? For those viewers who are unfamiliar with transfer pricing, this is the core transfer pricing concept. And the idea is, if you have a transaction between two related parties, you cannot rely on those two parties to have determined what the actual fair market value of that transaction is. For various, usually tax-driven reasons, there's an incentive to either exaggerate, overstate, or understate the price of the asset. So where you have a transaction that's subject to transfer pricing rules, you, to the extent possible, apply the arm's length standard, which is you try and figure out how that transaction would have been priced if the two parties had not been related to one another, but in fact been typical third-party market participants. And in order to do that, you try and identify comparable transactions. So if you're a Starbucks and you want to put your mermaid logo into a patent box that you own in the Bahamas or something like that, you want to look for other types of intellectual property, brands in this case, that are similar, that were sold, there was a transaction around them, and that are similar enough to this Starbucks move that you can say, well, our pricing is within the range of what we found in these comparable transactions. And that's really, I don't want to simplify, but the essence of transfer pricing. Now, of course, like with many things, it's the exceptions to the rule where things get really complicated. But at its core, transfer pricing is looking for comparable transactions that are similar enough to yours that you can then turn around to your tax authorities and say, we didn't have a wild variations in price for tax-driven reasons. We were in the market norms for this transaction. Now, there's two issues that come about here for people who are either familiar with transfer pricing or just thinking quickly on these points. The first is, and this goes to Hallmark E1, is this is burdensome. I mean, people make intragroup transactions, and we have back-to-back financing, as Eric said, but these happen all the time. If you were constantly having to search out comparables for all of these transactions, the administrative burden alone of satisfying the transfer pricing rules would outweigh the commercial value of doing the transaction in the first place, potentially. So many jurisdictions, they offer safe harbor rules, and they say for certain types of transactions, if you're within this range, or you meet these standards, or you can simplify it in the following ways, then you don't have to go find all these comparables and prove that or establish that your transaction was in the market range. Safe harbor rules are common, they're used everywhere, they make a lot of sense. In many cases, they're multilateral. So organizations will agree, regional associations or OECD or someone like that might agree to say, okay, for these types of transactions, let's all agree that this is the correct percentage. You get cost plus 2% for this transaction. These are low cost, what do they call it? I forget the term, but like basically very, very basic transactions. And those are fine under DAC6 as well. It's where you have a unilateral safe harbor. So it's only one of the countries, one of the jurisdictions involved in the transaction has this safe harbor rule. And when you're invoking that safe harbor rule, and if you invoke that safe harbor rule in the jurisdiction that has it, of course, but the other jurisdiction doesn't, then you need to submit a DAC6 report on that. And the other issue that you might have thought about when we're talking about the comparables and the arm's length standard, especially when I gave the Starbucks example, is, yeah, but what if there are no comparables? What if the asset being transferred is so new, or what if it's so different from anything else around it that you cannot identify any comparables in which to find out what the market rate would be? Well, these are generally referred to as hard to value intangibles, and they're inevitably intangible assets, which are basically assets that you can't hold in your hand. So you're talking about intellectual property, patents, brands, goodwill, know-how, everything that makes a company valuable that's not something that you can actually hold in your hand. And for it to be a hard to value intangible, which has its very own definition, which I want to read to you, the term hard to value intangibles covers intangibles or rights in intangibles, which at the time of their transfer between associated enterprises, no reliable comparables exist. And at the time the transaction was entered into, the projection of future cash flows or income expected to be derived from the intangible is very, very difficult to predict. So what they're really thinking about is if you do it at a time where you really just don't know how successful the product will be. Maybe it's maybe it's a vaccine that hasn't been tested yet, or maybe it's a new type of computer software that might become Android or might fall off and never be used by anyone. So in those situations, those are called hard to value intangibles. And where you have a hard to value intangible, you have a reportable cross-border arrangement under Hallmark E2. The final transfer pricing hallmark, Hallmark E3, is especially interesting because it's the stealthiest of all the hallmarks. And what I mean by that is usually when these hallmarks apply to situations where either you know you're doing it for tax-driven reasons and therefore you're not surprised to find out that a aggressive tax reporting disclosure regime would cover it, or you have a bunch of other tax issues related with that particular transaction. And so you're not surprised to discover that there's an additional, yet one more tax-related regulation that you need, with which you need to comply. Here, though, it doesn't necessarily happen that way. Now, there might be a restructuring and a transfer of assets, and you might basically wind up one of your subsidiaries and absorb its own subsidiaries or something along those lines. And then you're probably aware that there's a lot of tax activity going on. But it may also involve just the transfer of functions and or risks, not assets. So you might have, say, maybe you're a company with subsidiaries somewhere in the EU and somewhere in the US. And you decide, well, we really want to focus on our investments in the US. We really want to move the team over there. So you take the people or their jobs, if they don't want to move, and you move them to the US subsidiary. Now you're transferring the functions, and so that would meet the initial criterion for this. And if the result of this is that the profit shift drops 50% or more in the EU jurisdiction, then you would have a reportable cross-border arrangement. The trick is there's no clear tax incidence here. There's no transfer. There's no transaction. You've just moved jobs over or recreated the jobs over there from one jurisdiction to another. And it may very well surprise you to find out that there is a tax obligation connected to that transfer of functions and or risks. I didn't define EBIT. EBIT is earnings before interest and taxes. It's also referred to as operational profits. So what it tries to do is it tries to identify what your profits are independent of what the tax rate is in your jurisdiction or how you have financed the company, whether it's with equity financing or debt financing along those lines. EBITDA is another similar type of accounting term, and they've just used EBIT here. I don't know why, they're pretty similar. But that's what they're trying to do, is the operating profits versus any of the profits that could be modified by the local tax regime or the fact that you've taken out a lot of loans because that's how your owners want to finance you as opposed to direct capital contributions. But the takeaway here is, of course, that this can sneak up on you. So this Hallmark E3 is something you have to keep in the back of your mind anytime you're going to do any significant restructuring within a group, especially if the restructuring will result in one of those subsidiaries or enterprises shrinking significantly. Okay, that's the transfer pricing ones. We switch to the popular sheltering methods. Thank you. These are just very popular methods of tax reduction called tax shelters in the US and probably elsewhere. These will not surprise anyone because you almost always are doing these types of transactions for the tax reasons. So hallmark B1, acquisition of loss-making company. Company loses a lot of money, and therefore it has losses that it can usually carry forward to future years when it does make income and has some value for those losses. The company itself, it may never make more money, but and therefore it may never be able to use these losses, and it may be actually a worthless company. But for your company with lots of profits, if you buy that company and you dissolve it, then you get those tax credits. And so therefore, that company has value to you solely because it has tax losses that you can use to offset your earnings. This is a well-known trick, and this is very much not allowed. In most jurisdictions and under DAC6, you need to report it. Conversion of income character. So the taxation of various streams of income is often determined by the character of the income, whether it's, we say ordinary income in the US, that would be like wages, but you can also, there's also capital gains or gross proceeds. These are usually taxed at preferential rates. And a lot of tax gamesmanship is seeking to find a way to change the treatment, change the character, and thus the treatment of the income. Now, a great example here is employment compensation. So what if instead of paying you $100 a year, I pay you $80 and I give you shares in the company? Then in 5 years' time, those shares vest, the price of the shares goes up, and you cash out. Well, what you're cashing out, you're not paying the normal wage income tax on that. You're paying gross proceeds. So you've changed the character of the income. Now, fortunately, pretty much every jurisdiction that's released guidance notes has said, no, we don't want any news about employment compensation. We consider that to be a safe area away from DAC6 because we have specific rules that govern it. But it's a great example of the way conversion of income can work. Another way it works, very popular, is through how you set up a corporation and how you finance it. So if you have a receivable, someone owes you money, you stick it in a corporation, you get two benefits from that. Maybe you can dissolve or sell the corporation and you can pay gross proceeds tax on that, or maybe you can just hold the income there and in the absence of CFC regulations, you can just defer the payment of the income. It's not necessarily conversion there, but it certainly is a tax advantage that you obtain. And finally, B3, circular transactions. So round tripping, when you send money out of your jurisdiction only to bring the exact same amount of money back in. This happens in a lot of ways, most of which are well, kind of illegal outside of the tax code as well. But the one that's maybe most prominent is to take advantage of tax breaks for foreign direct investment. So if you see a company that you want to buy in your own country, but you know that your country offers tax breaks for investments from overseas corporations, and so you take the money you have in your home country, you send it to a subsidiary that you have in a different country, and then that subsidiary buys that company and gets a tax break for it. That's a circular transaction. The movement outside of the country to bring it back in, it had no commercial function. You're just round tripping the funds so you could take advantage of the foreign direct investment tax break. If you're doing that, you would qualify under Hallmark B3 as a reportable cross-border arrangement. All right, I'm really running over time here, for which I apologize, but I'm just going to rush through the reporting very quickly then. So the reporting must be made within 30 days. There's a requirement to submit bulk reports. So any reportable cross-border arrangements entered into between the 25th of June 2018 and the 1st of July 2020, so the original activation date of DAC6, must have been reported by the 28th of February this year in most jurisdictions, although some EU jurisdictions played some games with the timelines or just openly deferred them. Reports have to be submitted in the mandated XML format. And as Anna mentioned, one of our services at Bluebridge is that we will convert your materials into the mandatory XML format for your relevant for your particular jurisdiction. So if you need that service, please go to our website and you can obtain it there. And then, as I said at the onset, once these reports are submitted every quarter on a quarterly basis, they're exchanged, I think it's quarterly, amongst the other EU member states. Now, what sort of information is due? So the identification of intermediaries and relevant taxpayers, typical information, name, residency address, taxpayer identification number. Also critically, any associated enterprises of the relevant taxpayer who are involved in the transaction. So even if they themselves are not the relevant taxpayer or an intermediary, if a related party of a relevant taxpayer is in any way involved in the reportable cross-border arrangement, they need to be included in the report. Then much of the rest of the report is going to be about what the transaction itself is. So which hallmark did it meet? And you have to cite all the hallmarks it meets, not just, you can't just stop at one. And then the summary of it. So how does it operate? How are you able to set up this arrangement so that you reduced your overall tax bill, for example? That's what they're interested in, because like I said, they're purportedly collecting information on tax schemes. So not looking to enforce tax laws, but looking to identify emerging aggressive tax planning schemes before they get too widespread and start costing the EU treasuries too much money. And then, of course, the date on which it began and the value, and any EU member states that were involved or concerned with the particular transaction. Now, this is standard. This applies to all intermediaries. And the final slide we're going to look at here on reporting talks about what are the special reporting rules in the corporate group context. Well, as I said, in general, the definition of an intermediary doesn't really care if you're an external advisor or an internal advisor. And I think the expectation is that for most corporate groups, you're going to have a single company within the group who's going to be an intermediary. It's going to be where your in-house experts work. They're probably a corporate center, maybe your treasury center, or it could be your tax department within one of these subsidiaries. What's critical here is that that's fine. If you have one single entity and it's set up in the EU, you can make it the intermediary for all of these arrangements, and you can do all of the reporting, with maybe the exception of a few of these inconsistencies across EU member states that I keep mentioning. There's another situation, of course, where you're a smaller group and you have the in-house experts in the same entity as the operating business, in which case you would have these intermediaries advising the relevant taxpayers all within the single group. Now, what most jurisdictions say here is you don't have to do multiple reports. You don't have to report yourself as both the intermediary and the relevant taxpayer. Simply being the intermediary in those circumstances will suffice. And as a further extension of this idea, some jurisdictions, although this is not widespread, they've taken the position that where it's in those situations where you have companies that qualify both as intermediaries and relevant taxpayers, different companies qualifying as such, they're not going to object if the relevant taxpayer submits the report. I don't know what they're thinking here, or why they think it's necessary to do this, but what they're saying is you can shift the hierarchy of reporting in this circumstance. So typically, if there's any intermediary with a reporting duty that's not subject to the legal professional privilege, that intermediary needs to submit the report. Only in the case where there's no such intermediary does the relevant taxpayer incur the reporting duty. These particular jurisdictions are saying, look, we don't care. Take the intermediary, take the relevant taxpayer, whichever one you want to do the report, do the report. As long as there's no other intermediaries or relevant taxpayers involved in this transaction, you can choose which of the types of parties are going to submit this report. I don't know how widespread this is going to be, but this could be very useful for certain jurisdictions in how they set up their reporting, certain corporate groups, and how they set up their reporting functions under DAC6. Probably not so useful because it's not widespread enough to cover enough EU member states. The final point around special reporting rules in the corporate group context is the control of relevant information. So typically, you're not liable for your failure to report information that you have no reason to know, that it's outside of your control. And you typically look at that on the actual reporting party's basis. You're not obligated to go out and find out all the information you can about an arrangement. You're just tagged with the responsibility of reporting what you know. That rule is a little less strict in the corporate group context. You are in fact obligated to report the information that the corporate group has. So you have sort of an enterprise knowledge standard. So it's not sufficient for you to say, I didn't know how these other deals that these people were making involved in this arrangement. You have to go find out that information as part of your report, or your report will be deemed to be invalid. Okay, that's the reporting. And now we're just going to close out with the takeaways here. So key takeaways, intense impacts of this. The analysis is novel and quite demanding, and the timeline for reporting is 30 days from the execution of the reportable cross-border arrangement. So you cannot wait until the first arrangement takes place before you get your strategy set up for how you're going to handle DAC6 reporting. Pan-EU fragmentation. So the variations, not just of the DAC6 topics, which we've discussed, but also like actual how you define some of these underlying tax topics, whether it's depreciation or double taxation or any of these other factors, means that you really need to look into every single EU jurisdiction that's relevant in order to make sure you understand the full scope of your reporting duties for any single reportable cross-border arrangement. Strict liabilities and objective tests. It's not a very forgiving regime. If you have a reporting duty, then you're liable for it. There's very little chance you can say, I didn't know there was such a thing as DAC6, or no one told me that I might qualify as an intermediary. In this regard, ignorance of your duties is no defense. Ignorance of the law is no defense. Ignorance of the facts of the matter, or the circumstances, as we discussed earlier, that's a great defense. I know about DAC6, but I didn't know these details that would have made it reportable. But if you knew the details, but you didn't know about DAC6, well, you're still liable for non-compliance. Finally, reporting solutions. There's a range of DAC6 consulting options available, including through Bluebridge. But in terms of reporting solutions, Bluebridge is the only DAC6 analysis and reporting service that can offer you freedom from all of your DAC6 compliance concerns. As Anna mentioned at the onset, our motto is expert relief. We are looking for you to shift your responsibilities under DAC6 onto us so you can breathe easy and we can take control of the situation on your behalf. So that's it for me. Apologize again for going over time, but thank you very much, and I wish everyone a fine afternoon.